Is it time to start shorting the market? Is the market high in for the foreseeable future, right? Is the Santa Claus rally not going to happen? Well, what we're going to look at here is the triple Qs, which is the NASDAQ ETF. Now, FOMC was today. We've got a very strong initial reaction. We're down about 2% off of that. And what happened today is we've lost some daily support. So that daily support that we lost was a 5 and 10 day moving average. That lowest support was sitting at around 527. This market's got room to continue to come down. And that next spot that I would be looking at to see if there's going to be some type of reaction is going to be somewhere closer to 518, 519. That's going to be your 20-day moving average. Now, if we fail to get back over the 20-day moving average after losing it, let's say in the days or weeks to come, then your next spot that you're going to look for, kind of a strong intermediate support, is going to be 512. That might be a little bit of a better loading zone if and when we do get down there on some of those big tech names, right? So how are we going to play FOMC going forward? What I'm looking at, and until we close back over daily supply, any bounce needs to be looked at as a short opportunity, okay? Now, we could get a strong reaction where the market does try to chew up a lot of this selling pressure, and I can see us bouncing back into 530 all the way up into, somewhat close to 533, okay? It's going to be the days to come after that to see, do we continue higher, or was it just a back test for a continuation down into 519, 518? So that big level that I'm going to really be looking for going forward is any bounce that gets rejected between 527 and 530, 531. I want to see us reclaim 523 to the downside. If we start to give up whatever we close at today, again, today being the 18th of December, if we start to give up today's lows, you're going to have more expansion room down. Now, again, is this any type of scenario to be concerned about? Is the market going to be in a bear market? Guys, this is day one of a fantastic run higher ever since going back to around mid-November. If you really look at mid-November, that's when we kind of had that little bit of a gap down, and then we kind of, slowly have been grinding higher for a month. For about 30 days, we've been grinding higher. So this is just day one, guys. This is nothing to get too concerned about. There's going to be money to be made on both sides. What I really want to focus on is, especially early in the open, right? Off the open, those longs, if we do spike, be careful. They could be laying traps for that continuation down. So if you take any long position where, off the open, you're taking out pre-market highs, or you're confirming like a 30-minute opening range, look to treat it as a scalp where you're getting in quickly, you're getting some cash, and you're kind of waiting for that rejection to see if we can continue higher throughout the day. Or you're waiting for that kind of stall and then trickle down. And then once we lose today's lows, that's when you're going to really want to load the bank and try to hammer this into the 20-day moving average. Now, depending on where this wants to settle between market close and overnight session is going to be very, very crucial. Because if we continue to slide and we continue to sell off after the market closes today, and let's say, for example, we are trading down around the daily 20-day moving average and below it, okay? Then the situation turns into any type of washout, right? Any type of flush off the open could be a trap for that dead cat bounce. Now, I'm not saying the dead cat bounce is going to go and take out all-time highs, but just be cautious. So the way we're going to play this is, if we open up close to the 20-day moving average on a daily time frame or below it, we're looking for the immediate washout and the trap for a dead cat bounce. And then if we open up higher and we shoot up off the gates, then I'm looking for the rejection and the continuation through today's lows. That's exactly how we're going to play it. Whether you trade stocks, whether you trade futures, whether you trade options, it doesn't really matter. That's the way to play it. And again, right now we're in a little bit of an in-betweener range, right? So we're in between the 10 and 20-day moving average. It's kind of a soft spot here. We don't really have a whole lot of support. Looks like we're filling this little bit of a baby gap going back here to the beginning of December. That's got room all the way down to around 517, 516. I'd like to see what we do once we come back and test this prior swing high here. Again, we've engulfed a lot of days worth of work here. So 1, 2, 3, 4, 5, about 5, 6 days of engulfing was done in just this one move. So that's a lot of price action to eat up in one session. So again, that's the way we're going to play it. That's the way we're going to approach it. I hope you guys enjoy the video. Again, like, comment, subscribe if you want to trade with me each and every single day to kind of go over these levels. That link is down in the description box below, and I'll catch all of you guys on the next video.